If you're still trusting banks with your life savings, stop everything you're doing and watch this video. Pay very close attention to the warnings being shared by billionaire investors, Wall Street analysts, strategists, and multiple real estate industry leaders that we're about to report. Millions of Americans are in danger of losing everything they have ever fought for. And the worst part is that many of them don't even know it. Thousands of big U.S. banks are now facing an unprecedented wave of distress that could completely wipe out depositors' savings accounts in 2025. This is very serious, folks. Just a few days ago, Barry Sternlicht, the co-founder, chairman, and CEO of the $115 billion real estate giant Starwood Capital Group, came forward to alert the public about the impending collapse of the U.S. banking system. The head of one of the biggest real estate companies in the country is observing huge distortions in the market happening as we speak. The overwhelming majority of U.S. banks are heavily exposed to a huge pile of distressed commercial real estate loans that will continue to grow as the new year begins. Millions of depositors who think that their funds are secured by the Federal Deposit Insurance Corporation are about to find out the hard way that there are limits to what regulators can do when thousands of financial institutions start to fall apart at the same time. Sternlicht stressed that higher interest rates, rising vacancy rates, and inflation are causing extreme pain for over 3,000 of the 4,000 regional and community banks in America. Earlier this year, the executive told Bloomberg the office real estate market has been experiencing an existential crisis that could trigger $1 trillion in losses for banks. His prediction has proved to be accurate, and given that U.S. banks are currently holding $1.9 trillion on commercial real estate loans that are entering default territory, the system is a fragile animal right now, according to the billionaire investor. Most institutions that hold real estate debt but don't have large balance sheets to offset excessive loan losses could disappear with depositors' money, he suggested. Some institutions are not even expected to survive another month. Sternlicht warned, "I think people are looking for these cracks. You're going to see many cracks develop now," he said during an interview with the press. "From this point on, you're going to see a regional bank fail every day, or not every week, maybe 2 a week." The crisis is rapidly accelerating as commercial real estate prices drop off a cliff, leading landlords and investors to default on their loans. Since 2020, hybrid work grew in popularity, which resulted in a massive spike of office vacancies and left property owners with unprofitable office towers that could no longer pay for themselves. To make matters worse, since the beginning of the Federal Reserve's tightening cycle in 2022, elevated interest rates have raised borrowing costs for property developers, forcing banks to take on more risk. At the same time, higher rates reduced banks' asset values by $2 trillion. According to CBS professor Tomasz Pekorski, this decline has eroded many banks' capital buffers, rendering them more vulnerable to depositor runs and systemic failures. As of November, approximately 14% of all commercial real estate loans and 44% of all office loans are in negative equity, which happens when property values are less than outstanding loan balances. Furthermore, around 1/3 of all loans, including a majority of office loans, are likely to face severe refinancing challenges due to the more than doubling of debt costs following the interest rate hikes. The combined impact of asset value declines and rising commercial real estate loan defaults is significantly increasing insolvency risks for a substantial number of financial institutions across the nation, potentially reaching levels comparable to or surpassing those seen during the Great Recession. Piskorski's latest study highlighted that a typical bank in the United States is 90% debt financed and only about 10% equity. Most of the debt funding comes in the form of deposits, but only half of these deposits are actually insured. So, if a bank has $100 million worth of assets financed with $90 million of debt, in principle, even a 10% decline in the value of their assets due to high interest rates could result in insolvency, the strategist outlined. For an average regional bank in the United States, about 25 to 30% of their assets are commercial real estate loans, which finance office buildings, apartments, industrial warehouses, hotels, and more, Piskorski pointed out. These properties typically have long-term leases, which can make banks' cash flows particularly vulnerable to higher interest rates and declining values. Unable to repay their debts, landlords are selling properties at massive discounts, some of them losing more than 90% of their value. Meanwhile, lenders are selling off some high-quality assets in an attempt to make up for CRE losses. However, by doing this, they're also losing important funds that could help them to stay afloat in case depositors were to withdraw their money en masse. The thing many average Americans don't realize is that due to banks' exposure to the commercial real estate sector, their savings accounts are not secure. John Murray, the head of Pacific Investment Management Company's private commercial real estate team, cautioned, from shopping malls to office buildings, lenders of all kinds of assets are just beginning to face real challenges. The firm is not only predicting more bank failures in 2025 because of a very high concentration of troubled commercial real estate loans on their books, but also an 87.5% drop in the number of banks in America over the next 2 years. The real wave of distress is just starting, Murray emphasized. The same concern is being echoed by Scott Reckler, the CEO of the New York-based real estate investor, operator, and developer RXR. The banking system is facing a slow-moving train wreck, he said. With wave after wave of commercial real estate loans maturing over the next few years and values in the sector plummeting, banks will struggle to deal with rising loan losses, he argued. I think there's going to be 500 or fewer banks in the U.S. over the next 2 years, he warned. I'm not saying they're all going to fail. I guess many are going to be forced into consolidation if they don't fail, Reckler added. Whether you keep your money at a regional bank or at big institutions like U.S. Bank, J.P. Morgan, and Goldman Sachs, you might be more exposed than you're being told. Regulatory data shows that almost 70% of the nation's 100 largest banks have a total commercial real estate portfolio greater than 300% of their total equity. Meanwhile, smaller banks with less than $10 billion in total assets have an exposure to commercial real estate greater than 440% of their total equity. Among banks of any size, 3,777 have more CRE debt on their portfolio than real capital. In simple words, if a banking panic similar to what happened to Silicon Valley Bank in 2023 were to hit any of these institutions, they would not have enough money to cover all deposits. If you get lucky enough to be one of the first to take your funds out of your savings account before your bank collapses, you may actually be insured by the FDIC. But in case you're caught off guard by this crisis, your life savings could be completely wiped out overnight. With only about 50% of deposits actually insured, countless Americans are about to discover that their funds have never been safe. If you're not stocking up on cash while you still can, you may be left empty-handed as more institutions fail and seize depositors' money to make up for their own losses. Now is the time to go to your local bank and try to take as much money as you can out of the system before you end up losing everything. There are many ways to safeguard your savings, including low-risk investments and market mutual funds. The most pressing issue worrying financial institutions, regulators, Wall Street, and the public alike is the probability that a few more bank failures could set off a domino effect in the sector and break the entire system. A report released by the Social Science Research Network found that if only a fraction of U.S. banks became insolvent in the coming months, uninsured depositors could lose more than $300 billion. The analysis included 400 small, medium, and large institutions where the level of bad property debt exceeds reserve levels, and it found that they would only be able to cover about an average of 18 cents for every dollar lost on souring commercial real estate loans. Big names like Bank of America, Wells Fargo, Citigroup, and Morgan Stanley have seen reserves fall from $1.60 to 90 cents for every dollar of real estate debt on which a borrower is at least 30 days late. This is down from $2.20 a year ago. As losses start to become more evident and more people realize that their nest eggs are at stake, it's only a matter of time before mass bank runs lead us to the next bank failure. And when depositors become aware that their money will not be safe at other banks, a ripple effect could spark broader panic and push more people to withdraw their funds from other institutions as well. People will likely lose their confidence in the entire banking system as a whole, which will not only put the final nail in the coffin for many banks, but also drag the U.S. economy to the ground. Can you understand now why the experts are saying we're on the verge of a much deeper financial crisis than even what happened in 2008? The current number of distressed banks is unlike anything we've ever witnessed. The only way to protect yourself is by building your own cash reserve. This train wreck is about to start moving very fast in 2025, so make sure you jump off the wagon before a crash destroys everything you have ever worked and fought for. Thank you for watching.